In the next few minutes, I'll reveal how Canada's bold move to cut off billions in imports from the United States could transform your everyday life. I am talking about skyrocketing grocery prices, unexpected shortages at the dealership, and even higher energy bills that might catch you off guard. Until now, most people assumed trade between these two neighbors was unbreakable, but behind closed doors, a new reality is unfolding. Why is Canada taking this drastic step? What does it mean for your job security, your wallet, and global power balances? And most importantly, how can you prepare? Stick with me, because by the end, you'll see how this seismic shift in trade could change the way we live, shop, and invest. And what's coming next will shock you. The bold move that no one saw coming. For decades, Canada and the United States have shared a tightly woven economic relationship, with goods flowing freely across their border. From agricultural products to automobile parts, energy resources to cutting-edge technology, the partnership has been a cornerstone of North American trade. But now, everything has changed. This decision did not come out of nowhere. It is a calculated shift that is shaking industries, affecting jobs, and forcing businesses to scramble for alternatives. Many were caught completely off guard, assuming that Canada would never risk such a drastic economic separation. But the truth is, this move has been in the making for years, and its consequences are already unfolding in ways few could have predicted. The first signs of trouble appeared when Canada began re-evaluating its trade dependency. As tensions between the United States and other major economies escalated, Canada started exploring alternative trade routes, seeking out agreements that would make it less reliant on any single partner. This latest decision is the culmination of that strategy, a bold, deliberate move that could permanently reshape trade in North America and beyond. This is not just another trade dispute. It is a shift that threatens to upend the global economy, setting off ripple effects that will be felt in supply chains, financial markets, and everyday households. And yet, the real reasons behind Canada's decision go far beyond what most people assume. The real reason behind Canada's decision. Many believe this is just another battle over tariffs, or a short-term retaliation against United States policies. That assumption could not be further from the truth. Canada's decision is not about winning a trade war. It is about long-term survival in an increasingly unstable economic environment. For years, Canada has been watching closely as trade relations between the United States and other major economies deteriorated. When the United States began imposing stricter trade policies on China, Mexico, and the European Union, Canada took note. What started as isolated disputes quickly turned into a larger pattern, one that placed excessive pressure on trading partners and created uncertainty in global markets. Then there is the energy factor. Canada is one of the world's largest producers of oil and natural gas, but its energy exports have been heavily tied to the United States. Over time, this dependence became a vulnerability, leaving Canada at the mercy of shifting policies and unpredictable market conditions. Seeking greater stability, Canada started forging new energy deals with Europe and Asia, gradually reducing its reliance on the United States. At the same time, Canada has been positioning itself as a leader in emerging industries. Renewable energy, technology, and electric vehicle manufacturing have become key areas of focus. By severing its deep trade ties with the United States, Canada is betting on a future where it is less constrained by external policies and more in control of its own economic direction. The government has also cited the need for economic diversification. Relying too heavily on one trade partner, no matter how strong that relationship might seem, creates risk. And with global markets shifting, Canada is making a strategic move to secure its place in the new economic order. The effects of this decision are already being felt. The most immediate impact? A wave of disruptions across some of the largest industries in the United States. Who gets hit the hardest? The numbers tell a grim story. The United States exported hundreds of billions of dollars in goods to Canada every year. And now, with the sudden collapse of that trade, several key industries are facing an economic crisis. Agriculture is among the hardest hit. Canada has long been one of the biggest buyers of American-grown wheat, soybeans, dairy, and meat products. Farmers who relied on Canadian buyers are now left scrambling to find new markets, with some already warning of significant financial losses. Without alternative buyers, surplus goods are piling up, leading to lower prices and revenue shortfalls that could put many small and mid-sized farms out of business. Then there is the automobile industry. Canadian factories have been essential to the supply chain for United States automakers, producing components that go into millions of vehicles. With that supply cut off, automobile manufacturers are struggling to adjust. Delays in production, increased costs, and shortages of key materials are forcing companies to rethink their entire manufacturing strategy. This is not just an inconvenience, it is a crisis that could lead to factory shutdowns and mass layoffs. Energy is another sector in turmoil. The United States has long relied on Canadian oil and natural gas imports, but with trade restrictions in place, those supplies are no longer guaranteed. This shift is driving up energy costs and creating instability in fuel markets, which could have lasting consequences for both businesses and consumers. Technology companies are also feeling the pressure. The cross-border tech trade between Canada and the United States has been crucial for innovation and production. From semiconductor components to artificial intelligence research, collaboration has been a driving force in both countries' tech sectors. Now, with those partnerships in jeopardy, the industry is facing significant disruptions that could slow progress and lead to financial losses. The ripple effects of these disruptions are being felt far beyond boardrooms and factories. They are starting to show up in everyday life, in prices, in availability of goods, and in economic uncertainty. The immediate fallout, what's happening right now. Supermarkets, gas stations, and dealerships are already feeling the effects of Canada's decision. Consumers who rely on imported products from Canada are seeing higher prices and shrinking availability. And businesses that depend on Canadian goods are struggling to keep their shelves stocked. Supply chains that once ran smoothly have been thrown into disarray. Trucking companies that used to move goods effortlessly between the two countries are now facing logistical nightmares. Retailers that depended on Canadian imports to keep prices stable are being forced to pass higher costs on to customers. Even small businesses that relied on cross-border trade are scrambling to adjust, with many wondering how long they can survive in this new economic climate. At gas stations, the impact of energy disruptions is becoming more evident. With Canadian oil no longer flowing freely into the United States, fuel prices are creeping upward. This increase does not just affect drivers. It raises costs for transportation, delivery services, and even airlines, setting off a chain reaction that touches nearly every aspect of the economy. In the automobile market, dealership lots are already seeing shortages of vehicles that rely on Canadian-made parts. Prices are climbing, wait times are growing, and consumers are finding fewer affordable options available. Even those looking to buy used cars are feeling the squeeze as supply dwindles and demand pushes costs higher. And this is just the beginning. The economic impact of Canada's decision will not be a short-term challenge. It is a transformation that could redefine trade, reshape industries, and force the United States to rethink its entire approach to global commerce. Canada's shift away from economic reliance on the United States is a calculated move, creating opportunities for new trade alliances. As billions in imports are redirected, key players from Europe, Asia, and Latin America are quickly stepping in to fill the gap. Canada's new trading partners and the energy battle. European nations, particularly Germany, France, and the Netherlands, are expanding exports of machinery, automotive parts, and pharmaceuticals. Asian economic giants, led by China and Japan, have leveraged their supply chains to increase exports of electronics and industrial goods. Meanwhile, Brazil and Mexico are strengthening their positions as primary suppliers of agricultural products and manufacturing materials. This shift is not just about diversification, but long-term stability. By forging new trade agreements, Canada ensures its industries are protected from United States economic policies. For Washington, this represents a major blow, signaling the decline of its dominance in North American trade. Beyond goods and materials, Canada's shift is having a profound effect on energy markets. As a major energy producer, Canada has long been a key supplier of oil and natural gas to the United States. But recent geopolitical shifts have led Canada to seek alternative buyers, reshaping global energy flows. New agreements have strengthened Canada's energy exports to Europe, China, and the Middle East, reducing dependence on the United States. European nations facing energy shortages are securing long-term contracts, while China is increasing its imports of Canadian oil and liquefied natural gas. Middle Eastern energy partnerships further diversify Canada's market reach. For the United States, this shift presents a major challenge. With fewer Canadian imports, American refineries must turn to more expensive alternatives, driving up fuel costs. This impacts transportation, logistics, and the price of everyday goods, directly affecting consumers. More importantly, Canada's move underscores a broader trend. The United States is no longer the default trading partner for one of its closest allies. As Canada strengthens its energy partnerships, this realignment signals a long-term shift in global trade. But Canada's move is part of a much larger trend, one that extends beyond a single nation. Around the world, countries are forming new trade alliances and diversifying supply chains to avoid economic reliance on a single superpower. The rise of America-free supply chains. China is leading the movement, establishing economic agreements with Africa, South America, and Asia to secure resources and reduce American influence. Mexico, historically integrated into United States supply chains, is expanding its trade with Europe and Asia. India is emerging as a key global manufacturing hub, presenting a competitive alternative to the United States. These shifts signal a declining United States grip on global trade. While it remains a major economic force, its influence is weakening as more nations seek alternatives. Canada's decision is part of a larger movement toward economic independence and diversification. This transformation raises critical questions. If more countries continue to move away from dependence on the United States, what does that mean for its economic power? Could this shift mark the beginning of a new era in global commerce? The answers will shape the world economy for years to come, with consequences that extend far beyond trade. Canada's trade pivot is just one part of a broader realignment across global markets. As nations move away from the United States and reshape traditional supply chains, the cost of everything is about to go up. Prices for raw materials and consumer goods are already climbing, and further disruptions seem inevitable. This is not a minor adjustment, but a fundamental transformation of global trade, one that will leave consumers, businesses, and entire economies grappling with higher costs for the foreseeable future. The cost of everything is about to go up. If you think inflation is bad now, you're not ready for what's coming next. Prices have been steadily rising for years, but this latest shift in trade policy is sending shockwaves through the entire economy. What started as a strategic economic move is quickly turning into a financial burden for everyday people. The most noticeable impact: grocery bills that just keep climbing. Supermarkets are already struggling to keep shelves stocked, and with supply chain disruptions at an all-time high, the cost of essentials is surging. Fresh produce, dairy, and packaged goods are all more expensive than ever before, and there's no sign of prices stabilizing. Families are forced to stretch their budgets further, but wages are not keeping up. And it's not just groceries. Gas prices, already a sore spot for many, are becoming an even greater source of frustration. Without stable trade agreements in place, fuel costs are fluctuating wildly, making it more expensive to fill up a tank. The cost of shipping goods has skyrocketed, which means retailers are passing those expenses directly onto consumers. Electronics, home appliances, and furniture are also seeing sharp increases, making it harder for people to afford the things they once took for granted. Even the housing market is feeling the strain, with construction costs rising due to shortages of key materials. The price of lumber, steel, and concrete has jumped, delaying new home projects and making renovations nearly impossible for some homeowners. These rising costs are pushing more people to rethink their spending habits, cutting out non-essentials just to keep up with basic expenses. The financial pressure is mounting, and it's affecting nearly every aspect of daily life. Why buying a vehicle will never be the same again? Car dealerships are running out of inventory, and here's why. The automotive industry has been dealing with supply chain struggles for years, but this latest shift in trade policy has made things even worse. With key parts and materials now harder to source, automakers are facing production slowdowns they never anticipated. Factories that once ran at full speed are now struggling to keep up with demand, leaving dealerships with fewer vehicles to sell. As a result, car prices have surged, and buyers are left with fewer options and longer wait times. For those looking to buy a new car, the situation is especially frustrating. Popular models are selling out before they even reach the lot, and some automakers have resorted to removing features just to keep production moving. High-tech extras that were once standard, like advanced driver assistance systems and premium entertainment features, are being stripped out to simplify manufacturing. What used to be a choice between different trim levels is now a matter of taking whatever is available, even if it means paying more for a car with fewer features. And if you think turning to the used car market is the answer, think again. Prices for pre-owned vehicles have skyrocketed due to the shortage of new cars, making even older models significantly more expensive. Vehicles that would have once been considered budget-friendly are now being sold at premium prices, leaving many buyers with few affordable choices. Leasing is also becoming a challenge, with higher monthly payments and stricter terms that make it harder to find a good deal. For many, this means holding on to their current vehicles longer than they intended, delaying upgrades simply because the market is too unpredictable. The entire car buying experience is shifting, and the changes may not be temporary. Thousands of jobs could disappear because of this decision. While trade disputes often seem like distant political battles, their real impact is felt by everyday workers. Who's about to get laid off? Entire industries that rely on stable supply chains are now facing serious disruptions, forcing companies to reconsider their workforce. Factories that depend on imported materials are slowing down production, leading to temporary shutdowns and job losses. Automotive plants, electronics manufacturers, and construction suppliers are among the hardest hit, with many already cutting hours or laying off workers to compensate for rising costs. Farms are also feeling the effects, with major export markets closing their doors. Agricultural producers are left with surplus crops and livestock that they can't sell at competitive prices. This means lower earnings for farmers, leading to layoffs in agricultural processing and distribution. Many of these workers have spent years in the industry, and now they are left scrambling to find new opportunities in a job market that is growing more uncertain by the day. Trucking and logistics companies are also in trouble. With fewer goods moving across borders, there is less demand for transportation services, leaving truck drivers, warehouse workers, and shipping coordinators in a difficult position. Some companies are slashing routes, while others are shutting down entirely, unable to keep up with the changing economic landscape. The same goes for tech industries that rely on imported components. Semiconductor shortages and supply chain delays are forcing major firms to cut back on projects, leaving engineers, factory workers, and support staff with dwindling job security. It's not just blue-collar workers who are at risk. White-collar jobs in finance, marketing, and corporate management are also being affected as businesses tighten budgets to cope with rising costs. Companies that once thrived in a booming economy are now struggling to stay afloat, and that means cutting expenses wherever possible, including staff. The uncertainty is growing, and for many, job stability is no longer guaranteed. The ripple effects are spreading, making it clear that no industry is truly safe from the impact of these trade shifts. Could this lead to a U.S. recession? The last time trade wars escalated like this, it triggered a global meltdown. Economic downturns often start with a few warning signs, and right now, all of them are flashing red. Inflation is out of control, job losses are mounting, and businesses are struggling to adjust to new market realities. When these factors align, the risk of a full-scale recession becomes very real. Consumers are already spending less, tightening their budgets as prices rise. This decline in spending slows down the economy, affecting everything from retail sales to home purchases. Businesses that once relied on steady revenue streams are now facing serious challenges, leading to further cutbacks and layoffs. The stock market is reacting to the uncertainty, with major indexes experiencing volatility as investors try to make sense of the shifting landscape. Banks and financial institutions are also bracing for potential instability, with rising interest rates making borrowing more expensive for both businesses and individuals. The housing market, which has been a key driver of economic growth in recent years, is now cooling off as higher mortgage rates and construction costs push buyers out of the market. The cycle of economic decline is a difficult one to break. As companies downsize, more workers lose their incomes, further reducing overall consumer spending. This creates a feedback loop where declining demand leads to even more job losses, making it harder for the economy to recover. While government interventions may help stabilize certain sectors, the long-term effects of these trade shifts could take years to fully resolve. The uncertainty is growing, and with so many economic pressures converging at once, the question isn't if a recession is coming, it's how soon. Is this the beginning of the end for United States trade dominance? For the first time in modern history, the grip of the United States on global trade is beginning to loosen. What was once an unquestioned economic powerhouse, controlling supply chains and setting the terms of trade for the world, is now facing a major shift. Countries that once depended on the United States for essential goods, financial stability, and economic alliances are finding new paths, ones that bypass Washington altogether. The decision by Canada to cut off billions in imports from the United States is not an isolated move. It is part of a much larger trend, one that has been unfolding for years. Nations across Europe, Asia, and Latin America are reevaluating their economic ties, exploring trade partnerships that are less reliant on the policies and economic fluctuations of the United States. The reasons vary, but they all point to the same conclusion. Dependence on a single economic superpower is now seen as a risk, not an advantage. The shift did not happen overnight. It started with trade disputes, economic sanctions, and policies that forced countries to consider alternatives. The last 2 decades have been defined by tariffs, supply chain disruptions, and financial instability that have left trade partners questioning whether the United States is still the most reliable option. Canada's move is just the latest example of a global trend toward economic diversification, one where regional agreements, independent trade networks, and shifting alliances are rapidly taking shape. The impact of this change will not be felt immediately, but the long-term effects could be irreversible. When major economies pivot away from the United States, it forces corporations, industries, and governments to adjust. Investments that once flowed freely into American markets may now be redirected elsewhere. New supply chains will emerge, reducing the influence of Washington on global trade. Even the dominance of the United States dollar, the backbone of international finance, could be at risk. If this trend continues, the role of the United States as the central hub of global commerce could fade, leading to a new economic structure where power is more evenly distributed. But the biggest question remains: who stands to gain the most from this shift? The United States versus China. Could this strengthen America's biggest rival? The strategy of the United States has long been clear: restrict access to trade, impose tariffs, and create economic pressure to weaken competitors. But what happens when those moves end up strengthening the very rival they were meant to contain? For years, Washington has been tightening restrictions on trade with China, imposing limits on advanced technology exports, increasing tariffs on Chinese goods, and encouraging businesses to relocate production away from Chinese factories. At first, this seemed like a calculated move to reduce economic dependence on China. But as Canada and other nations pull away from trade with the United States, it is Beijing that is stepping in to fill the gaps. China has wasted no time in expanding its influence over global markets. In recent years, it has built strategic trade partnerships with countries across Latin America, Africa, and the Middle East. When Washington cut off Chinese companies from advanced semiconductor technology, Beijing responded by pouring billions into domestic research and production. When the United States imposed tariffs on steel and aluminum, China ramped up its partnerships with European and South American producers. And now, as Canada and other trade partners move away from United States imports, China is positioning itself as the alternative. This shift is about more than just trade. It is about influence. For decades, economic dominance has been the foundation of global power. The ability to set trade policies, control supply chains, and dictate financial regulations has given the United States an undeniable advantage. But as more countries diversify their trade networks, China's position is growing stronger. Beijing has already secured major trade agreements, including its expanding partnerships through regional trade organizations. It has invested in infrastructure projects across multiple continents, making it an essential player in global supply chains. It has also taken aggressive steps to challenge the dominance of the United States dollar by pushing for transactions in its own currency, reducing reliance on Washington-controlled financial systems. The result? A gradual shift in global economic power, one that is increasingly tilting in China's favor. If the current trend continues, the restrictions imposed by Washington may not slow down China's rise at all. Instead, they could accelerate it. As more nations move away from American trade, the real winner may not be Canada or Europe, but the very rival the United States has been trying to contain all along. What happens next is uncertain, but one thing is clear: this is no longer just a trade dispute. It is a fundamental reshaping of global economic power, and the consequences will be felt for years to come.